Is that a Daytona?
Yeah. 07. What year's yours?
Hold on. Got one on?
No.
No? All right. I don't know. I really don't know. I don't have it new.
Let me see.
I didn't
04.
know I was a Daytona guy until I had one.
No.
I really love it.
And it's amazing how many people will look at it and say, I can't believe you have a Daytona. How long have you had
But
it?
when did you know you wanted a Daytona?
So a buddy of mine is a pro golfer.
Okay.
And they have a connection with Rolex. He called me up and he had one. He goes, I can get 2 more. One's for you and one's for Scotty Cameron. Do you want the white face or the black face? I said the white face.
Yes.
He goes, good, because Scotty wants a black face.
Okay.
And I didn't even tell my wife. We went, picked it up, paid for it.
Okay.
Back then it was
$4,000?
an $8,000 number.
$8,000.
Yeah, not
and
anymore.
And my wife was like, what's wrong with you? And then the market crashed afterwards. She goes, it's your fault. You bought a Rolex.
Yeah,
You
top.
did."
You put the top in the market.
Right.
Was it your first Rolex?
It was first Rolex. Yeah.
And your last Rolex?
Well, I put my name on a wait list for one.
Okay.
And they called me. And when they called me, I was like, if you don't want it now.
Yeah.
And it was the Batman. And I was like,
Ooh.
yeah. And I was like, I don't know.
Barry has that.
Yeah. And I said, I'll take it. And then I put it, it's still in the box. And my son's probably going to get it at some point in
Okay.
time. So it's got the stickers and all that.
If you put it on, I'm selling everything.
Now that you know that I'm
now
a
that
top
I know the
ticker.
history.
No, but speaking of
So there's an actual index for this,
Rolex
right?
or the
Yeah.
Daytona Rolex?
where? Let me say.
I just Googled Rolex index and it shows
Yeah.
rolled over a little bit.
Yeah. It was a big pandemic thing.
So putting the top in New York City, pension might put in the top. I hate to say it. There's a report from Reuters. They're exiting all hedge fund investments, and there's a quote. So they have $51 billion in assets. The New York City Employees Retirement System. Quote: hedges have underperformed, costing us millions. Let them sell their summer homes and jets and return those fees to their investors. That sounds a little toppy.
That could be. That's a nice little signal there. A
little bit.
I wouldn't want to put that press release
I think
out.
it's more political than anything else. It's
Yeah.
Letitia James. This is the one that thinks she's going to win the election for Biden by tying Trump up in court. I don't know that that's a market signal. I think that's just like a I don't know.
Well, is anything really a market signal these days? So much noise.
Yeah, there really is a lot of noise. I would tell you though that we spent most of this year kind of hovering between 4 to 4.3% yield on a 10-year and $75 and $80 on oil. And
Right.
2.5 weeks ago, both of those broke out significantly. And the market rolled over significantly for really good reasons. There was no compelling reason to stop this run we've had since the middle of October of last year.
Right.
You know,
Now there is.
Now there is,
Yeah.
right? It's like we're not in the same place anymore.
Yeah.
Wait, what's the reason that you're
I
buying
was
more
saying 'cause-
Rolexes?
no,
Not yet, but I will let you know when I hit the bid on that.
Are you excited to be on the? When was the last time you were on the show? Do you remember?
no, Art's never been on.
No,
oh,
I'm telling-
Ben.
I'm telling Ben.
Ben.
Oh, who was I here with last time?
I'm trying to remember.
Oh wait, it was a good one.
Bob Elliott?
Bob Elliott.
Oh yeah, that must have been a while ago. I feel like that was a while ago.
Ben's for the listeners. Ben's looking fitter than ever.
Thanks, Michael.
You
You
are.
guys both look fit too because you're training for a run.
Are you doing it, JP Morgan?
I don't think I'm going to be here.
Art, are you running?
I am not. I'm not. I've got shin splints like you.
There we go. There we go. A true fan.
Wait,
a true fan.
have you ever run in the JP Morgan Corporate Challenge?
I sure have. 12
Okay.
years ago.
For which firm were you
I was
at?
at Jeffries at the time.
Okay.
Yeah.
Did they field a large team of runners?
They did, and I was the largest of them.
You said it like do the chickens have talents?
Wait. When was the
Right, Ben?
When was 12 years ago? I might have been in that one.
When was 12 years ago? Dude, math is hard.
I was told there'd be no math in
2000.
this.
Okay. You take 10
2012.
off and then you take 2 more off.
Very confident.
All right. Ben's here. Art's here.
I don't think shin splints is a real thing.
No.
Art,
It's made up.
What is a
Art
shin-
and I
well,
both
what is a
suffer
shin-
from.
What is a shin
we have
splint?
faulty shins. Let's just say that we have faulty shins.
If you overexert and try to run too fast, you have massive.
If you've
pain in
literally
your shins.
never run in your life, your shins are going to hurt.
I started I did the Catch to 5K app. I'll be ready.
I don't think it's a shin splint. I think you're just not in running shape yet because you have to run. I think Ben's right.
I don't want to run.
I think a shin splint is an actual thing that you don't have. How do you know you have that?
The last time I ran, I developed a bit of a lower back issue, and then I sneezed and I blew up my back. So I've got an aversion
not a
for
shin
running.
splint.
That's
Any other excuses before we start?
Fat. I have asthma. I'm bald.
Yeah, asthma.
My parents got divorced. I could keep going.
Bald is a good thing. You've got aerodynamics.
Yes,
Sure.
I was gonna say you should run with your head down. That'll work out great. Hey John, how we looking?
Looking pretty good. How are you, Duncan?
Hey, we're good.
Okay, give me 1 second.
Is that a faint? Is that music in my ears? There we go.
Yeah, start rapping. Hey Ben, are there speed limits in Michigan yet?
What?
What's the speed limit on the highway in Michigan? I was having an argument with somebody.
Some of them are 75.
I think that's how I remember it. I thought I was saying
That's
85.
That's aggressive.
Pretty good, right?
No wonder why insurance is up so much. It's your fault.
Coming in with 3 plats.
All right.
You know, Duncan got a ticket from the Autobahn,
Oh, boy.
Coming to friends.
which I didn't think it was possible.
Hi, kids. Do you like Primus? Want to see me stick 9-inch nails through each one of my eyelids? Do you like options trading? Well, if you do, you should be trading options at public.com or on the Public app. And I'll tell you why. There are no commissions, no per contract fees. Public actually pays you a rebate of 18 cents per contract traded. That's pretty cool. Trade 1,000 options contracts on Public. They'll pay you $180 in rebates. Start paying less than $0 to trade options only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. 139! Who's excited? Excited for the show today, Duncan?
I am.
Fired up?
Yeah.
Nicole is fired up. Rob's in the house. Daniel's here. John is here. Ladies and gentlemen, I want to call you a veteran, but I also want to call you a legend. But I don't want to start off like making you blush. But to me, you're legendary because ever since I started in the business, I was aware of you. I was reading people quoting you in Barron's. I was seeing you on TV. So for me, for the length of my career, I consider you to be a legend. Is that okay? We start off on that footing?
That's spectacular, but I have to tell you how that started, and it's kind of an embarrassing story.
Okay, let's do the embarrassing story first. Wait, let me give you an intro, and then you tell the story. Ladies and gentlemen, Art Hogan is the chief market strategist at B. Riley Financial. Art was a floor broker for Fidelity in the 80s and early 90s, head of institutional equity sales and trading for Dean Witter, trader for Morgan Stanley, director of strategy and research at Jefferies and Lazard. Art has worked as a member of the board of governors of the Boston Stock Exchange and as a member of the board of directors of NASDAQ. Art Hogan, welcome to the Compound and Friends.
Thank you very much.
And Ben Carlson. Our listeners know and love you. All right. Tell us the story. How did I come to be aware of you as a young man starting in the industry?
All right, so I was kind of working as the head of sales and trading at Dean Witter, so World Trade Center. If you can imagine that, CNBC had just started.
Yeah.
And a fraternity buddy of mine had gotten a job at USA Today, and he thought he was going to the sports page, and they put him in business. So he calls me up. He's like, "Hey, you got a pretty big job. Can you describe why the market's doing this today?" And back then I was probably 32 or something like that. So I said, yeah, more buyers and sellers, the usual
Tried and true.
gibberish.
Yeah.
Greenspan's probably going to say something tomorrow that'll calm things down, but it's a little volatile today.
Yeah, something with the VIX.
Right.
The
The VIX didn't even exist back then.
Okay.
So this is back when we had paper tickets. So anyway, that gets published in the USA Today. I was like, no one's ever going to see that. Literally the next morning, CNBC calls me up and says, "How can you be quoted in the USA Today and we don't know you? Would you come on TV?" I was like, "Sure." When? I was thinking, like in a month. They're like, 1 o'clock.
Yeah, because you're hot.
And I've never been on TV. So I'm like, sure. So imagine a February day in New York where you put on your overcoat, but you don't need it. And then you walk from the World Trade Center to the New York Stock Exchange. But instead of being down on the floor, they're up in those little closets that were up in the balcony. And they had these lights, except they were 10 times hotter. And so now I'm sweating before I get there. I'm like the guy on network news that's doing the Saturday anchor job, and I need a beach towel.
Yeah.
So I finally calmed down a little bit. And then Maria is new to the job, and she goes, "Oh, I'm going on first." I'm like, all right. So she has to mic up. And to mic up, you have to kind of work the mic up and put it on your thing here. And I was like, what's going on?
Are you afraid they were miking you?
No, she was unbuttoning her shirt, and I could see her camisole. And I'm Irish Catholic from 7 kids. I've never seen someone's camisole before.
Yeah.
So Then she goes, "Oh no,
Sorry, what the hell is a camisole?
I don't know."
It's like a lady's undergarment.
Okay.
Right.
You of all people don't know what that is? Okay.
So anyway,
Keep going.
long story short, she goes, "Oh no, they're doing you next." So reverses the process and gives me the mic.
You took
So
your
if-
shirt took your shirt off immediately?
Well, no, but now I'm sweating even more. So then I just push my hair back.
Yeah.
They go on, they ask me some questions, I answer them. I walk away, they'll never call me again. That was the worst thing I've ever done in my entire life. I come back, the whole trading desk stands up, they're clapping, and they were like, they put a lot of product in your hair, didn't they? I was like, nope.
Yeah.
This is soaking
Pure
wet.
flop sweat.
And then after that, they just kind of kept calling me, kept saying yes.
What year is this?
This is probably 94, 90.
Okay. So there's no internet.
Right.
If you go on TV, millions of people see this, and everyone you've ever met sees it.
Right.
And they call you on a landline phone.
Right.
And leave you an answering machine message. Hey, I saw you on TV.
Gets even better than that. So
Okay.
I said this was the penultimate moment,
Yeah.
thinking I was using that correctly.
Yeah.
And an English teacher of mine from the 8th grade wrote me a letter, found my address, sent it to me, and said, penultimate would be the second best. I think you meant ultimate.
That's right.
And I was like, you have this much time? And she was like, oh, not like good job on TV, or we never thought you'd make anything out of yourself. It was much more of you used it wrong. I was
All
like,
right, so now Dean Witter looks at you and says, "Oh, we could use this guy."
yeah, yeah. And then Dean Witter merges with Morgan Stanley, which is kind of weird. Dean Witter bought Morgan Stanley, and everyone sort of forgot that.
Right.
And I wake up in the morning. So the head of the bond desk is living in the same apartment with me down in Battery Park City, and we're like crossing the street, and he goes, "Can you believe this news?" I was like, "Yeah, how is Michael Jackson going to come up with that money? He just got like a fine for something." So I'm reading the Times because the Wall Street Journal's on my desk. He's got the Wall Street Journal. It's like, we just bought Morgan Stanley. I was like, oh, that's probably more important to me. I probably should I should probably find out what you're talking about.
So wait, so when Dean Witter bought Morgan Stanley, which name remained? What did they
Morgan
call
Stanley.
it?
Well, we know which name remains.
They called it Morgan Stanley Dean Witter for
I
about a
remember
cup of
that.
coffee.
And then it got dropped, right?
Then it got dropped. Yeah.
That's like Solomon Smith Barney. And
Right.
it's like,
yeah.
So Art, what was the role of a chief strategist back then versus what is it like today?
Well, basically, it was very much of the being able to answer questions about what's moving things around. And also with that skill set, be able to sort of drive branding for the firm that you're at. So it's like, if there's somebody out there from Cantor Fitzgerald, if there's somebody out there doing this for, Morgan Stanley or Goldman Sachs, we want to have somebody out there doing that for us because it was just starting to be much more of a PR as well as, speaking at conferences, going on the road, talking to different financial
So
advisor
the
offices.
the message of the firm, what's different about our outlook from someone else's.
Right.
And that drives business
Right.
and the awareness. It's a huge deal.
So
Yeah.
Art, were the questions from clients or guys on the desk or both?
For the most part, it's coming from both. And you can tell which is coming from which. The angrier the question was coming from a sales guy, it's coming from a client.
Okay.
Right? So it's very much of you would never speak like that to me, but obviously you're talking to somebody at a hedge fund
If
that's
somebody lost
yelling at
money.
you. Right, exactly. That's
Okay.
yelling at you. So, explain what went wrong here.
So in those early days, who's the biggest strategist on Wall Street? Is it Abby Joseph Cohen?
For sure, 100%.
Okay. Ralph Acampora is still out there.
Yeah, 100%.
Who else?
Yeah. And that
You
would
remember?
I would say those are the two largest that everybody knew.
And that was
They did
Goldman and
complete-
Prudential?
Yeah, and they did completely different roles. So
Yeah.
Abby was just the S&P 500. Like if you asked her about NASDAQ, she was like, I don't really follow that
Right.
at the time. But she always had an outlook. And while they were going public, there was an assumption that she was being so bullish because they were going public, which is wrong. She hadn't changed her tune for 5 years. Ralph Acampora was really the sort of starting of all the technical analysis. And he was, he was the godfather of the
Media loved Ralph because he would give you like targets and like to the decimal point.
Right.
He would be really specific and they love that. Also, he was mercurial.
Right.
He could be bullish on Monday, bearish on Friday, and they really love that.
Right.
So Ralph was a star.
Have the targets always been there for you, or is that a newish thing in the last couple decades?
They've always been there for me, but people pay more attention to it now because they can hold your feet to the fire and say, okay, this is, how do you get to this? Give me an explanation, et cetera. But when I was at Morgan Stanley, it was Barton Biggs and Byron Wien.
Oh yeah. And are they both passed now?
Byron Wien just passed.
Yeah.
Byron Wien recently.
Yeah.
Okay.
And but every Monday we had to we'd have a meeting where I'd sit next to those two guys and we'd talk to the whole firm, and it was in an auditorium.
And you saw them in their prime-ish?
Right. Yeah. And throwing me into there to talk about what's going on in the world compared to these two guys, like literally thank God I had a jacket on because I would have sweat stains down to my belt loops.
Yeah.
And like no one would know how nervous I was. And these guys were just like, jovial. They could do, with their hands tied behind their back what they were talking about. And everyone loved them, but they never agreed with each other, which I thought was terrific. It's good to have dissenting opinions.
Do you have, looking back on your storied career, do you have like a moment that is most fond where you're like, I can't believe I nailed that, or I got it so wrong, or I was embarrassed, or made people laugh, or whatever? Like, is there anything that stands out to you?
Yeah, 3 things. So here's the first. I'm on with Maria at some point in time. I hate to bring it up twice, but apropos of nothing, she said, do you own any gold? And
What year is this?
this is probably 97, 98-ish. And there's only 2 ways to answer a gold question. And
Gold is almost $0 per ounce at that time.
Right.
People don't know this.
Yeah, and
Was it $40 an ounce?
something like that.
Yeah.
But it was also about the same. You get a dozen eggs for about an ounce of gold. But you could also never make anybody happy if you talk about gold because they either love it or they hate it. So it's binary. So to get out of that trap, and it meant nothing, but to get out of that trap, I said, just my wedding ring. Ha ha ha, and I got done with the interview. So I get back to my desk. My wife's working at Fidelity time, and it was like, my phone's ringing. I pick it up. She goes, it's platinum, and you're an idiot. I was like, oh.
That's how fast.
Right. And
Right.
then I was probably a little cavalier about talking to reporters in the beginning, not knowing that, people.
Don't worry, I work with Barry. I
So
know.
I
get it.
They might read what you have just been quoted as.
Yeah.
So somebody called me, and I forgot what it was, like Investors Business Daily. And I was like, oh, all right, who's going to read this? So big mistake. So like, what's going on today? I was like, the market's going down like free beer. Well, they take that line and print it as the headline of the story, and then the
course
rest
they
of the
do.
things that I said.
Right.
So I literally get a written letter from a guy in Australia that said, that was the cheekiest thing I've ever heard, mate. We're putting in the book of great quotes. And then there's he's got some website. He puts all these quotes in, and it still sits there today.
The market's going down like cheap beer.
No,
Like free beer.
We're
Like
going to use
free
that.
beer.
We're going to
Yeah.
use that.
We're
That's
gonna-
good.
That
I've
might
never
be
heard
the
that.
name
That's a
of
good one.
That might be the name of today's podcast.
That's right.
You know, I said on TV, I got yelled at the other day. I said somehow maybe NVIDIA, like it was rallying.
Yeah.
Said NVIDIA's running like a scalded monkey. They're like
A scalded monkey.
You got in trouble for that?
What in the world?
they're like is there's a little bit of like a shades of animal abuse to that for
Oh, yeah. That's
running
true.
like
Yeah,
a scalded monkey.
Yeah.
Can you not say that?
I think it's a pretty common term. I can't believe that was frowned upon in
so,
that
so
institution.
you know me, I probably said it 2 more times after.
Yeah.
All right, what was the third moment?
We talked about the scalded monkey, and I forgot. So I'll come back to it.
Scalded monkey. Okay, geopolitics. We're gonna do this again.
Yeah.
So, how many times have you seen this throughout your career? It's earnings, it's interest rates,
Right.
it's the normal stuff,
Right.
and then something terrible happens.
Yeah.
We seem to have a lot of that in the last couple of years, but so be it.
Right.
This is, I think this is something that's been well established. Geopolitics are not a great thing to focus on if you're not even a long-term investor, even a short-term investor now.
Right.
My question to you is, do you feel as though stocks recover faster than ever from geopolitical issues? Something that might have taken us 6 months to get over now takes 6 minutes.
Like the Gulf War. We're going
well,
to the Gulf War.
right.
Back in the early 90s.
I don't think any of this stuff holds the market's attention
Right.
for more than a half an hour.
Right. Well, first and foremost,
Do you feel the same way, though?
going back 30 years, there's always been 5 things that you're really concerned about. The names of them change, right? So
Yeah.
now it's easy. We can say, okay, Russia invaded Ukraine. We've got Israel and Iran, and we're worried about China and Taiwan. That's enough in any given year. Well, those same 3 things, you just change the names of the countries and say, okay, what's happening? To your point, the reaction function
You
has
feel
gotten a
like
lot
it's faster. Do you agree with that?
Yeah, everything's faster, right? All the
Everything's
cycles happen
faster.
faster.
Okay.
Yeah.
We didn't even have time. So the attack on Israel was Saturday.
Right.
I think futures were higher Monday.
Mhm.
So did we panic on Sunday night? I don't even. Normally, from my opinion, like 5 years ago, that would have been like a week.
Right.
Would have been oil price spike, and it would have been, it would have been like a week.
But it's also the awareness, right? The
Yeah.
24-hour news cycle, okay, everyone's informed as to how little damage was done, how successful we were at shooting down 320
that's a good point.
missiles and drones, and no damage was done. One person got hurt, et cetera.
That's true. Your imagination could have run wild
Always.
in the past,
Always.
and now it doesn't need to.
Right.
Well,
So
the other thing is we talk about 24/7 trading being an inevitability, for better or for worse. Crypto assets dumped immediately
Right.
on the news. And I suspect that SPY, if it was 24/7 trading, would have done the same thing.
Right.
And we had we had, 36 hours or whatever it was to digest and assess. And
Crypto has not V-shaped higher though, and stocks.
neither stocks.
Right.
Yeah, I guess.
Are you the biggest surprise to me at all this is that there's simultaneous wars going on in commodity important countries, and oil has essentially gone nowhere for like 15 years.
Right.
How is this possible?
Because we are a bigger producer.
Is it
and
just
now-
'cause the US
and now
is producing so
exporter.
much?
Yeah,
Right.
it's all.
And we're oversupplied. Like we're largely oversupplied. The only bid that you can put in oil right now is a fear of disruption of supply. So
And that's a refiner story or a LNG story.
100%.
Right.
And so you have that fear. It's like if this escalates and they take out oil production from Iran, who's gone from 2.5 million barrels a day to 3.2 million barrels a day. So that could be a problem. But if you go back to the Russia-Ukraine thing, when we spiked from $72 to $105 on WTI, it came back down in 2 weeks because we didn't lose that supply. We put sanctions on it. It just went to China and India.
So we used to do all these pieces on our blogs, and brokerage firms have been doing this for 25, 30 years about how over the long term, none of these geopolitical crises have really had a lasting impact on the market.
Right.
You don't even have to do it long term though.
Right.
So now you can say 6 hours, 4 days,
Right.
whatever. Let's put this chart up. John, the first chart, ignore geopolitics. Michael, what are we looking at here?
So, all right, take a look at the screen. We showed what happens 1 year after various geopolitical events: the Reagan shooting, 9/11, the Iraq-Kuwait invasion, Brexit, Cuban Missile Crisis, etc. And sure, sometimes the market goes down. I mean, the Yom Kippur War was obviously in the midst of a secular bear market in 73, 74. But the median return is 13%. Now, you could play games with numbers. So if you look at the average, it's down to 5%. However, if you back out the Yom Kippur War, and I know this is doing a lot of mental gymnastics here, but the Yom Kippur War was down like 50% a year later. Take that out, and the average return is 8%. So it's about average.
Right.
In other words, geopolitical events, while obviously important and tragic and all that sort of stuff, just through the lens of the market, it's not something that investors should pay attention to.
Also, who picks this list? Because the more of these
Sure.
we add, the more the result will look like just regular market
Exactly. Well,
performance.
that's
So
true.
Mike, create this
Sarah.
one for me. What do you think the Dow did the day after Kennedy was assassinated?
Went up.
Our cash and told that story.
5%.
Yeah, I quoted you on that this week. Actually,
Crazy.
Yeah. I wanted to talk more about oil with you, Art. So I threw this into the conversation because I thought it was really interesting. We had a hot inflation print this month.
Mhm.
There's a concern that one of the things that's the least under the Fed's control is the impact of crude oil prices.
Right.
That's just like there's nothing they can do about that. And actually, if you remember 2008, one of the weirdest things that happened is I think crude almost hit $200 a barrel.
Right.
It didn't last long.
Right.
Okay. There is an impact if oil gets out of control on CPI, which would undo a lot of what the Fed's been able to do, even if it's just in the headline.
Right.
This is Bank of America research. So we're not there. So the point of this chart is to say we're not there yet where there's a huge impact on CPI with oil prices, but we could get there. Quote, the recent increase in oil prices have led to questions about the impact of oil on inflation. While higher oil prices do put upward pressure on inflation, the increase to date should have little effect on core CPI, all else equal. There are both direct and indirect effects from higher oil prices. The direct effect can be simply thought of how higher gasoline prices affect headline inflation. So energy is 6.7% of headline CPI. So we really haven't had enough happen for that to like meaningfully take CPI from, let's say, 3.5 to 4.5. Like we're just not there yet.
Right.
But we're also not that far away.
Right.
That's going to change everything if that happens.
Yes and no. And
Please.
everything you say is correct about that, except for the fact that gasoline prices take up way more of our mind share than they do of our wallet share. So think about
True.
how much more productive you are or we are in using energy. Whether
People
it's
used to spend more on their budget to energy in like the 70s than they do now.
100%.
Right.
Actually, almost 100%, more than 100%. So it used to be 12.5% of your outlays in the 70s all the way into the early 80s.
Right.
Now it's between 4 and 5
Okay.
total. So
Yeah.
when you think about, but it's the number one thing. If you're, at the bagel store, if you're getting a cup of coffee, people tell you how much they paid for gas and how that's crazy.
Well, so the indirect effect, while it may not percentage-wise be a big part of CPI, it's a huge part of inflation expectations.
Right.
So when you hear Jay Powell say expectations are well anchored,
Mm-hmm.
well, they won't be at $100 crude, I think.
Right. But what about the offset of if, in fact, you're paying more for energy overall, you pay less for everything else, and that's disinflationary for the other goods that you don't buy
Why does that happen? Oh, got it.
because you don't have the money to do it, right?
Right.
So when you balance out your budget and say, okay, now I know
So that's an indirect effect that's positive.
it's positive towards inflation.
Not positive
It's
for people don't feel positive
Right.
about it,
But
but
it
it'll make the
offsets-
data better.
It offsets what you're going to spend money on.
That's a really good point.
Interesting.
That's a really good point. I hadn't thought about that.
I can't afford to go to Taylor Swift because gasoline's at $4.
Right.
Right. Or I'm not spending this much on a hotel room. And if everyone says that,
Right.
then the hotel room price comes down and that will show up in CPI.
Right.
So it was really looking good for a while for the soft landing camp.
Yeah.
It was really looking good. And then, damn it, we just couldn't slow down. Can't
Right.
stop, won't stop spending. John, throw this chart up, please. So Bank of America does a global fund manager survey, and they ask what is the most likely outcome for the global economy in the next 12 months. And again, the case for the soft landing, I mean, it was just going up and up and up. It peaked in January at 71% respondents said that. And now, what's coming up the rear big time is the no landing scenario. That was down to like 6% in December, and now it's up 6x to 36%. Art, what are your views on what happens to the economy over the next 12 months through this lens?
Well, what's no landing versus soft landing?
Yeah, that's what
Let's
I was
start
going
with
to
that.
say. Yeah, well, if you describe that, no landing, basically means the economy keeps chugging along and inflation takes much longer to get closer to the Fed's target.
That's not good.
Correct.
No landing is not good.
It's not a positive because you're going to be living in a 4.5% funds rate.
Well, that's the thing. To me, the no landing means higher for longer.
right.
You mean it's not good for the markets? That's good for most people. The economy stays strong, right?
But it might be because if earnings continue to outpace
3.5% to
inflation worries.
4.5% inflation is good for most people.
If it comes with 6% nominal GDP, right?
I suppose.
Would you rather have that, or would you rather have like 1% to 2% inflation?
See,
and like
Josh, this is
3%?
what I'm dealing with every week on Animal Spirits.
I'm
You see?
I'm
So
asking the
complacent.
question.
No, it's a fair question. So think about in December.
I
we
don't know
thought-
the answer actually. Now that I think about it.
In December, we thought there was going to be 6 or 7 rate cuts.
Okay.
Flash forward 2 months, and we thought there was going to be 3. What did the market do? It went significantly higher, up 12% at the end of the first quarter
Because it was for the right reason.
for the right reasons. So the right
Yeah.
reasons would be that. Does
Well,
it-
because earnings growth
right,
was better than inflation was bad.
correct.
And
And GDP was better in the third and fourth quarter and looks to be better in the first quarter of this year. So investors were willing to forego rate cuts for better earnings.
right.
What's the pivot? When does that change? That's the big
Well,
question.
we're in earnings season.
Right. But if in fact we thought there was going to be, consensus was 1.5% growth in the first quarter, and it looks like it's closer to 3, do you think earnings are going to disappoint? broadly?
No.
So, but is
No.
that no landing, or is that's no landing? It sounds like.
it's no landing, but maybe it's a longer runway.
But where are you? Are you soft landing?
I'm in between soft landing and no landing only because the Fed doesn't think
That's a
that-
Boston hedge right there.
Yeah, exactly. The Fed doesn't think they're going to get to their
Proud of
target
that outlook.
until 26. Like they haven't penciled in 2% core PCI until 2026.
I mean, but their track record of forecasting is
Yeah, so is ours, right?
it's
Yeah.
Will Ferrell hilarious.
Right. They thought they were going to do 3.5% at the most in terms of rate hikes at the beginning of the cycle. They got to 5.5.
Remember, no, we're not considering 50 basis point rate hikes,
Right.
and then they did 475
But
basis
there's
point rate
no way
hikes.
anyone would have thought the economy could handle 5% rates
No.
this high for this long.
I didn't.
Right.
I didn't either. Or
Right.
7% mortgage rates.
Right.
That's right. And
Right.
we're gonna talk more about why we even think that's possible right now, actually. So I asked this question. I was on TV with Jeffrey Gunlock, and it was right after a Fed meeting.
Right.
So I do like Wednesdays on Closing Bell.
Right.
So Jeff was great. He's explaining to Scott what he thinks the Fed is saying, blah blah blah, and then they made the huge mistake of letting me into the conversation. Like Scott turned to me. He's like, Josh. I'm like, hey Jeff. What if actually high rates are causing people at the top end of the income spectrum to spend more than they otherwise would because of the wealth effect from all the yield,
Right.
just literally a geyser of cash in their bank accounts and their money market funds. He did not like that. He just looked at me like, you are an
I
idiot.
saw it. His head almost popped
So
off.
why is this guy in the same segment as me?
Right.
Shout out to Jeff, by the way. Love Jeff. Okay. But so more people are saying this though now. Now, I'm not an economist.
Right.
I'm a guy that has theories like everybody else.
Right.
So I don't mean to make it sound like I absolutely know this is happening.
Well, many people are saying it. In
I
fact.
can't be talked. Many people are saying this. I can't be talked out of it right now. So Bloomberg did a piece. What if this is them, not me? What if Fed rate hikes are actually sparking U.S. economic boom? So it's the same thing as what I was saying. You've got people that are in money market funds earning 5.5%. Why wouldn't they be spending like crazy?
Right.
And they are.
Right. And think
okay.
about where the bolus of all that is. It's sitting with baby boomers that have most of that money, right?
Yeah.
They don't have a mortgage, and if they do, it's below 5 or 4 or 3% on what they have left. Everything's worth more, and to a certain extent, they don't 5% without risk. Why would they lock it in?
5% no risk versus average annual returns of 7% in stocks.
Right.
Who the hell would pick 7?
Here's my counter to you.
Well, one last thing. My father-in-law put this idea in my head months ago. He said, I was around in the early 80s and I knew rich people. My father is an accountant. So he worked for rich people in the 80s. And he said, if you had no mortgage in the early 80s, there was nothing better.
Right.
You were being paid double digits, risk-free in a bank. Forget about treasuries, in a bank account.
Yep.
You were being paid like there's no tomorrow. And if you had no borrowed money out there, you felt like the king of Siam.
Yep.
Okay.
And they throw
so
a
why
toaster
would this
in,
be
too.
materially different? I understand it's not 18% interest rates today. It's 5.
Right.
I understand all these things. But why wouldn't there be some flavor of that? And think about what the early to mid 80s was like. It was a worship of luxury and wealth.
Right.
And I don't think that's coincidental.
Everything
So,
that guy just said is bullshit.
all right.
Fair enough.
Talk me out of it.
So
I want you
No,
to.
no. I don't think that's bullshit. But here's what I would ask: Do you really think that somebody with a lot of money is spending more or less because of what they're earning in their money market account?
Yes.
I disagree.
So
with
here's the
that.
counter. Dario Perkins at TS Lombard wrote about that this week. He answered this question. He says the marginal propensity to consume of borrowers is 3 to 5 times higher than that of savers, which is why they're debtors in the first place. So he's saying, like, people saving that money doesn't necessarily mean they're spending more. Maybe people are spending more because they feel like, hey, my house is up, my stocks are up.
Yeah.
But it's not necessarily
No,
the high interest rates.
I understand if you give people money who are in debt and like really need it, they'll spend it faster.
Yes.
If you give a rich person money, they're going to park it in a treasury bond fund.
Right.
And that's not the argument. That's not the argument. The argument is there a wealth effect from 5% interest risk-free? And my argument is, of course there is.
Right.
Just look at the section of the economy that caters to the top 10% of households.
It is true that the rich people continue to spend money regardless
Dude,
of
it's
inflation.
berserk.
They don't
Right.
care.
It's berserk.
Think about the recency bias of what they're used to getting.
That's
for
my
parking that
point.
money, right? So it's
15
getting-
years, it's
That's
zero.
15 years is 0, and now it's 5%. So the order of magnitude, it's not the early 80s when it was 13 and 15%,
Okay.
but the order of magnitude is significantly larger.
But when you listen to corporate conference calls, companies in the luxury sector, we just heard from LVMH,
Yeah.
their customer is the customer I'm talking about. They don't have credit card debt. They're not a mortgage. So for them, this is just free money being shot at them via like a cannon, like a T-shirt cannon. It's like, oh, the month just went by. Here's another $1 million on your
Who's the richest
on your
generation?
$50 million
The
fortune.
baby boomers threaded the needle perfectly on this.
Yes.
Like, here's a stock market, bull market for 15 years.
Yeah.
Here's a 3% mortgage or pay off your house. And oh, by the way, right when you're retiring, here's 5%.
Yeah.
Perfect timing.
So I think what we're saying, if the Fed wants to slow down this economy, they're going to have to cut rates immediately. Is that crazy?
And then housing takes
No,
off.
I'm just kidding. I don't think that'll help either. But
Yeah.
I don't think that'll help either. Why haven't we seen more of a negative impact from 500 basis points in interest rate hikes?
I think the biggest thing to me is that we had so many years of low interest rates that everyone got the joke and said, if I have a mortgage, I'm going to continue to refi it
Look,
down.
that's the chart.
Right.
So, John, throw this chart on the screen. We're looking at the U.S. effective rate of interest on mortgage debt outstanding, which is under 4%,
Right.
versus the current mortgage rate, and the gap is hilarious.
Yes.
It's never been that wide.
It's ridiculous.
Current
And
rate is 7.
Yeah. So the
and
point.
everyone learned from the housing crisis that they're not going to have a variable, they're not going to have an arm, they're not going to do any of that. So everyone sort of got this 30-year fixed, and they're sitting pretty. And the problem with that is you can't get any of them to sell their house, right? So you're not going to have any mobility until we have a 5 handle on a 30-year fix.
Yeah, and at that point, people have so much equity built up, they're going to pull that equity out, and that's when there's going to be a housing activity,
Right.
either HELOCs or I can trade up finally.
I could trade up finally.
Look at this. We've never seen
or
this
trade
before.
down. Baby boomers want a smaller footprint.
This gap is just all right. So to Michael's point, the existing mortgage is the red line.
Yeah. Yeah.
Okay, it's under 4%
That's like a weighted average of all outstanding mortgages.
versus between 7 and 8% for a new mortgage.
So all these people that have locked in, Ben, what are the numbers on how many people have mortgages in this country? Is it
Well, 40% of all of them have been paid off, essentially. So yeah, 60% of homeowners have a mortgage.
and like 80% of them are under 4.5%.
You know what's so funny? If they really wanted to do what they say they want to do, which is help the first-time buyers or the people that are, they're locked out of the housing market because of high down payment, and if they really wanted to do something about it, they would take this effective current mortgage rate average, which is let's say 3.9, and they would just say, okay, first-time home buyer, we'll give you that mortgage. You would see housing activity, I think, in the bottom 2/3 of the housing market overnight.
Well, so Ben and I have been talking about this in the past, that if the Fed wants to do that, they could start buying mortgage bonds again. That might sound crazy, but here's a chart from Bob Elliott. I did not throw this in the doc, but it is timely. He says the agency market is shifting away from the Fed and banks and toward direct and indirect household purchases who likely require increasingly better yields in order to get incremental demand.
Right.
So that's what happened. That's why not only are interest rates higher, but the spread
Spread is way higher.
But the spread between mortgage rates and treasuries is wider too. So
Correct.
it's like a double whammy.
So at some point in time, you would think there's got to be some mean reversion there, right? So what's we're at 7% for 30-year fixed rate?
Yeah.
now,
7.5 almost.
So it hit 7.5 today.
And the norm, right? The 25-year average between the 10-year and that is what, 125 basis
Yeah, it's
points?
bad.
So we're significantly above that. So at some point in time, but the only way for that to happen is that someone steps up and says, okay, I'm selling and I don't care about the mortgage that I'm getting, right? And the only way to get that, again, it feels like it's recency bias. If you see 7.5 and that goes to 6.25,
That's
bad.
when
it explodes.
people are going to act on it.
Every Wednesday, you're going to
100%.
see, mortgage apps just exploded. What happened? Well, 6.25 sounds a lot better than 7.5, and I think you start to see that, but you just need some mean reversion between that spread between the 30-year
So-
fixed and the 10-year.
Now here's the bad news though for the people that are like, if only mortgage rates were lower, I could get into the housing market and buy my first home. What do you think prices are going to do if mortgage rates fall back?
There's going to be no supply again.
Right.
Right.
It's not going to be easier.
But one of the things, if you look at new home builders, the new trend, and I think this is something that's been coming for a long time, size.
Yeah.
Like, did we really need to make 2,800 square feet the average
Right.
Right.
starter home? So that's gone down over the last 2 years.
They're
home
making
builders
smaller
make
houses again.
which makes sense, right? Do you
Yeah.
really need 3,000 square feet
Right.
as your first home?
It's incredible how the average size of a home has metastasized over 20 years.
Right.
It's like, and it just became standard.
Yeah.
So if you saw a new build construction, they were not building 2,000 square foot homes
Right.
because it was hard to market that.
Right. And
Every house with a mudroom now.
Yeah, so many mudrooms.
Right.
Well, you're famously anti the starter house. So maybe you're part of the problem.
Well, I think what people need to do is extend how long they're going to be in their house for. If they're worried about it, don't live in a house for 3 to 5 years. Make it 7 to 10 years minimum.
Skip the starter. Try to get into the bigger home. Easier said than done.
Or find something that you're going to be willing to stick in, because the frictions of trading up for a house are so large.
Yeah, I never did it. I'm in the same house since 2008. So call the crib, same number, same hood. It's all good. Let's do earnings. Yeah. What's the house outlook at B. Riley right now, and how has it changed since the end of I assume you put out your target December.
Yeah.
So has it changed at all?
No, but it was pretty aggressive, I thought. So the S&P 500 24 earnings estimate consensus was 243. And I'm at,
$243 for the S&P.
yeah, and I'm at 253. Why am I at that? I think we're always too conservative. 75% of companies beat. They usually beat by this much. You just have to do the simple math, and you can draw a line to something close to that.
Yeah, extra $10 a share. It's just NVIDIA.
Right, exactly. Right, or energy. Have you seen the energy companies' first quarter estimate increases?
Yeah,
massive, and they're still only 3%, 3.5% of the S&P 500. That's going to change. That's going to be a double, I think, over the course of the next 2 years. Worst performing sector last year.
You want to be overweight energy because the earnings estimates are going to go up more than other sectors.
More than other sectors, and we just found out a week and a half ago at the major conference that they have that the average cost per barrel is like $35.75.
Wow, versus what on the market? 80.
Yeah.
Right.
So think about that, right? It's like, are they making money at $80 or $70? And are they being rewarded for that? Are there multiples demanding? And they're not at all. Like all of the majors trading at 12, 13 times, throwing off handsome dividends. All the North American E&P companies trading at 11 and 10 times because nobody wants to touch energy.
I added to energy stocks for myself the other day, and my research associate Sean Russo and I keep a list of the best stocks in the market,
Right.
and we're looking at technicals, but we're also looking at they have to be profitable companies.
Right.
And there's a whole bunch of hurdles to make this list. The list size is not finite. If there's 0 stocks, there's 0 stocks. It just is what it is. The only stocks left on that list after this week are energy.
Is that right?
Yeah. Every other, I think there's maybe a couple of defense stocks, and then
Yeah.
everything else got knocked out. And again, it's a combination of various technicals.
Right.
But the technicals are aligning with the story that you're telling.
Right.
It's crazy to me that semiconductors are 9% of the S&P,
Right.
and energy stocks are 3%.
Right.
Because that ain't what the economy looks like.
Right.
Do you think
Semiconductors are really important.
Do you think
but
owning energy stocks is a better hedge against higher inflation than even the commodities themselves?
I do because it's easier to invest in it, right? So owning the commodities themselves, you don't have to be in the futures markets. You've got the roll costs and all the things that are encompassed in that. It's a lot easier to either pick one of the ETFs that represents how you want to express that opinion,
Right.
or to pick the 3 of your favorite names. And either way, I think it's a winning bet. But to your point, yes, I think it's a better inflation hedge because that's exactly what's happening in energy right now.
I think the newer generation of investors think that stocks have to go down for energy stocks to shine, because that was the experience in 2022. But you and I remember environments where the market not only didn't have to move in the other direction, but oil stocks were the leaders.
Right.
You remember like 05, 06? This coal was a
Right.
leading sector.
Right. Absolutely incredible. And
Yeah.
think about how the multiples were back then, too. They were trading above a market multiple.
16 times earnings
16
for
times
drillers.
For drillers, exactly.
You would never see that now.
Yeah.
Okay.
Well, they went through that whole cycle where we had negative prices on crude, and all these guys had to get religion about being shareholder friendly, returning, running profitable businesses. But they've all done that. So we're at a point now where you look at, I think it's laughable how cheap the sector is, and I think it continues to do well.
What's the message of what we heard from the large banks last week and yesterday?
I would say in general that I think the fact that JP Morgan went down 6% only means JP Morgan was one of the top 10 stocks in the S&P 500 before they reported price for perfection. And they said we didn't make as much net interest income as we thought we did. But if you look at the rest of the report, spectacular. Top line, bottom line, checked all the boxes. And they gave conservative guidance on net interest income, which a lot of people have baked in with higher rates.
So I want to ask you about that.
Yeah.
The stock's down 20 points from when it reported. I'm a points guy.
Yeah.
Stock's down. Are you a points guy?
I am, yeah.
All right.
As a matter of fact, I'm talking 8s and quarters if you want.
You new guys don't understand. Stock's down 20 sticks
Yep.
from where they reported, right? All they did was leave net interest margin guidance alone.
Right.
They didn't cut it.
Right.
They just didn't raise it.
Right.
They're saying like 89, 90 billion in income,
Right.
and people wanted them to say 93.
Right.
Okay. So you whack 10% off the share price for that. Okay, fine. Why didn't they give more aggressive guidance given where rates have moved
Right.
since the last time they reported? My theory is they think they might have to actually pay depositors on that.
Right. Right.
Michael says no. What do you think? We don't know yet.
Yeah,
but
that's a good point. I mean, their deposits are so sticky, and they have the most, right? And they also had to, take in all the regional banks that didn't do well.
so you think they don't have to worry about deposits yet? Pricing.
Not
No.
yet.
So I'm so mad that I deleted this quote from the doc earlier today because I just didn't think we would get to it. On Bank of America's earnings calls, I think these numbers are right. They said that like 68% of their deposits have been there for the last 10 years.
Right.
Like money just doesn't move.
Right.
And if you haven't moved yet, the banks are not all of a sudden be like, oh shit, now like we already did that.
Right.
If you were going to leave for a money market fund, you probably already did it. And if you didn't do it, you're probably not going to do it.
Game theory.
There's no-
let's say
there's no
one of the
friction.
banks. Well, let's say one of the banks decides they're feeling froggy.
They're not going to. You don't think these people talk?
What if Jane Fraser says, "Oh, Bank of America, J.P. Morgan, Wells Fargo are paying 0. We're paying 1%." How much money? I understand it's more expensive,
Mhm.
but do they get money in motion by doing that, or do you think no? I don't know the answer,
We've
but
already seen in a frictionless world that these people aren't moving their money. So are they going to move
Okay.
it? You know what I mean? So,
But I don't know if
Yeah.
somebody gets aggressive. Maybe.
they've been offered that 1% somewhere else already, right?
Okay.
In a frictionless fashion.
So you
So
think?
I think it would
all
be
right, so you agree
terrific
with
to see.
Michael? You think
Yeah.
the cash sorting phase is over?
It's like changing your dentist. It's too much work.
Yeah. No, I wait for my dentist to retire. That's when I change
Who
that. I
goes
agree
to
with
the
you.
dentist?
You think it's too much work though to move from Wells Fargo to Bank of America, but it's not too much work to wire money from Wells Fargo
Totally.
to Fidelity for a money market.
Totally.
It's funny that it's like that,
Yeah.
but it is
Yeah.
like
But
that.
it's true.
Yeah.
You know why? Because I've been with Chase for since I opened a bank
It's
account.
auto deposit.
I'm not leaving.
It's,
All your
Auto
bills are
deposit,
tied
all
to
your
it.
bills are
Yeah.
tied
I have
to
a
it.
20-year history with that bank.
Right.
all right, so you're not concerned by the reaction in the banks to what you feel was like decent earnings, decent guidance. They went up a lot.
It just no, and which is interesting. They always lead with the banks, and we're supposed to make some sort of judgment about what the earnings season is going to look like.
And it never works.
It never works. Ever.
Okay.
So I always look at that and say, yeah, that's like
What's the first stock that reports that you think does give you some inkling? Is it MasterCard? Is it
MasterCard,
Home
Visa.
Depot?
Remember, it used to be Alcoa used to be first.
I'll call it alphabetically.
I remember Fahmy had a great
was-
tweet. He used to say that Alcoa is the Iowa caucus of earnings.
It was so true. I don't think it matters until NVIDIA reports when you think about it like this.
All right, I love this conversation.
What turned
Say more about
what
that.
turned the market around the last time we were going through a downturn?
NVIDIA last spring ended the banking crisis.
Right.
Literally knocked it
by
off
its-
the front page.
by itself. And what happened to their multiple? Their
Wow.
forward multiple.
Went down. Earnings guidance went up.
Right. It's insane. So do you like? Am I going to sit around and say I hope Walmart and Costco do okay? So that'll give me a good reading on the consumer.
Right.
When I just got retail sales for
All
the
right,
last
well,
2
let me-
months that are much better than
So let me make you nervous now.
Okay.
ASML lithography, one of the most important chip companies in the semi ecosystem.
Mhm.
They just gave downbeat guidance and said orders are not materializing at the rate that they thought they would.
Right.
Lower end user demand and customer demand. Taiwan Semi, same story. Conservative guidance today.
Right.
What do we make of that then? If you think NVIDIA is really important, is NVIDIA going to buck that trend?
All right. So I don't think Taiwan was quite as negative as
Ben is
ASML.
going to do some hedging while
Okay.
you explain.
I would say right now that ASML was a lot more negative and a lot less important than Taiwan Semi, and I think Taiwan Semi was a lot less negative. And
I agree.
actually, if you listen to the conference call, they said we are making chips for everybody, including NVIDIA. So anybody that matters, whether it's Qualcomm or the rest of the ecosystem, we're the one game in town. Now, where that might change at some point in time, 5 years down the road, where Taiwan Semi is not the lead manufacturing and somebody can do it, but it's not happening right now. And do you think demand's going down in the near term? If
They didn't give great guidance, is
Yeah.
all I'm
Yeah.
saying. So I don't know if that really has an impact on NVIDIA, but
9% of the S&P, so maybe we should be
you would have felt better if they said things have never been stronger,
Right.
which is what they said last quarter.
you could ignore, I think to a certain extent, having both of them say it in the same week
Yeah.
is kind of a wake-up call.
Yeah.
For sure.
Well, they whacked in Intel and
Yeah.
a bunch of those stocks.
AMD
came
is down 27% from the high.
in.
Yeah.
Yeah.
It's a lot.
Yeah. Well, how much was it up going into the
A
drawdown?
lot.
we
Quite,
had?
quite a bit.
Yeah.
Let's take a look at this earnings growth.
This is a good chart. So this is from FactSet. S&P 500, those companies that get less than half of their revenue in the U.S. Is that less than this? Yeah. They're growing 5.9%
That's
year
the
over year
green.
in the first quarter. That's the green. All S&P 500 companies are growing 0.9%. So if you get less than half of your revenue in the U.S., you're up 5.9%. If you get more than half of your revenue in the U.S., then you're down 1.8%.
Wait, what's the reason for this?
I'm very confused. Why is that happening?
Especially with a stronger dollar.
Positioning,
No, honestly,
currency. I don't know.
this is like because this would
This
say
is,
that like
this is large versus small, isn't it?
Yeah.
Isn't that what this boils down to? The
Oh,
bigger
okay.
companies do business all
Okay.
over the world.
Yes,
Right.
that makes sense.
Right.
Okay, so call FactSet, tell them I solved it.
That's-
What else do we want to do? Sectors. So when you give people the outlook going forward, how important is like sector calls or overweights, underweights to you?
Every sort of quarter, we look at this and say, how should we set up a barbell approach? And by the barbell approach for us, we look at it and say, okay, here are the three sectors we think are going to outperform this year, but certainly in the short run.
So what are you basing that on?
Basing valuation,
Okay.
like how undemanding multiples are, and how the macro should drive what's happening right now. So here's an example. Healthcare, beginning of the year, looking at healthcare. Went through the whole entire pandemic. If you weren't a therapeutic or a vaccine for COVID, nobody wanted to do anything with you. Across the entire healthcare platform. Last year and a half, last 18 months, if you don't have a GLP-1, weight loss,
Funny how that
diabetes
happened,
drug,
right?
and everything else is really trading at an unchallenged multiple, especially when you sort of look at these phase 2, phase 3 biotech companies. That the big pharma needs to gobble this up, and they're all cheap, right? One of the worst performing sectors this year. So you look at that, you can make a multiple argument, but you can certainly make a fundamental argument. It's like, okay, we're going to be over GLP-1 drugs, and we're going to start to look at, besides Lilly and Novo Nordisk, what hasn't worked. And I think that happens, and it certainly happens when M&A starts to pick up.
Okay, so you'll take a sector like that. That's one side of the barbell. What's the other side?
The other side, I think you have to balance with large cap growth stocks that are going to be dominant, thematically dominant, and hopefully they have predominantly reasonable valuations that you can describe. So look at a Microsoft. Obviously, you can say, okay, I'm fine with it. Nvidia, multiple keeps coming down every time they open their mouth. You can sort of live with that. Things get cheaper, when Facebook goes down or when Alphabet goes down, and say, okay, we can add that to the list because it's certainly not challenging anymore. Sort of looking at Apple right now as a place that that should probably be on the list and take something out.
Michael and I were talking about Apple this week. What did we conclude? We asked, is Apple in trouble?
I mean, they are in trouble. The stock is not cheap and they're not growing. So that's not a great place to be. And technically, it looks like shit.
Right.
So
there's definitely
this
some
is like a
headwinds.
very important stock. I know Microsoft is larger by market cap, but Apple is to me more important.
Right.
To like the investor psychology, I think. What do we do with this?
Do you remember when Apple invented the laptop? Oh, that's right. They didn't. Remember when they invented the cell phone? Oh, they didn't. They've never invented anything. They've been a fast follower. Remember when Apple told us what they're doing with artificial intelligence? Oh, they haven't. Are they going to in June? Absolutely. They're going to partner with somebody.
So, all right. So you with me.
June Worldwide Developer Conference. They're going to tell us something exciting. We're going to get freaked out.
They better.
AI Siri has the ability to stop the stock from falling, I think.
Yeah, for sure. And if you say, okay, this is who we partnered with, this is how powerful this will be, and oh, by the way, it's going to be on your next phone, so you need to get it, right? Because there hasn't been an upgrade. The biggest drag for them is it's like Nike, right? The sales in China are terrible. China's GDP report, if we believe it, is much stronger in the first quarter than it was in the fourth quarter. So perhaps that demand picks back up.
Do you worry about concentration of the largest stocks and the historical analogs to Nifty 50 or like whatever? Like, do people ask you questions like, does it make sense to you that 23% of the S&P is 7 companies? And is that toppy?
There's never been a year where it hasn't been. We just change the names every year. So if you go back to 1974, do you have that chart?
We do. John, throw Exhibit 29 up there, please.
So if you go back to 1974, and I would argue you can go back to 1900 if you'd like and say, okay, you know what? The railroads are way too much of the Dow Jones Industrial Average. Well, because they were the fastest growing, largest companies in America. It's always going to be the case. And then if you go back to 1974, it's going to be something like a General Motors or an Exxon and then you work your way through. It's GE for a lot of years. You always have leaders. You always have leaders. It's just the names changed. Microsoft was in and then they were out. Now they're back in.
This isn't more extreme, though, than a lot of those examples?
I don't think it's ever been more extreme. Or I don't think it's ever been less extreme.
Less extreme.
Less extreme.
Okay.
I'm sorry. Yeah. So, to the extent that you sort of look
What is this chart saying?
All right. Well, so this is from Ned Davis. Meb Faber tweeted that. And what we're looking at is the S&P 500 versus the S&P 500 excluding the top 10 market cap stocks.
Mm-hmm.
And historically, I guess really until, 2015 where the leaders just keep leading, if you had bought the S&P 490 and just avoided the 10 largest stocks, you actually outperformed. And clearly this has not been the case since whenever FANG came into existence, 2015 or so. But historically, avoiding the top 10 stocks has been a pretty profitable strategy.
Wait, it looks like red is trailing the whole way up. Am I missing something?
That's exactly that's exactly the point.
Oh, that's the point.
That's the S&P 500. The blue line is the S&P 490.
Okay. Oh.
So historically, there is a lot of more recycling in the top 10. And to me, this is the biggest theme, question, conundrum thing for the next decade, because we've lived through a 10-year period where it's been Apple, it's been Microsoft, and it's been Google and Amazon, and they keep winning. So what is going to knock them? I mean, we don't need to get to this right now. Who the hell knows? But all right, this is your point earlier that this is the chart showing the biggest stock in the S&P 500.
Oh, look at that.
And what are we looking at?
Yeah. So, look at the fact that did you ever think General Motors was the biggest stock in the market?
That is crazy. Look
It
at how
hasn't
long
been
I
it
wouldn't
took.
have guessed that it was for 30 years. What is that?
Well, the
20
crazy
years?
the crazy thing about this chart is we're looking at the percentage of net income. And holy moly, General Motors used to account for 10% of all the earnings.
Hold on. This is the earnings of the S&P by like the companies that comprise the most of the
Right.
S&P earnings.
Yeah. And look at General Electric. And the Microsoft comes in, it goes out, comes back in.
Yeah.
ExxonMobil. So it's and if you back that up, you're just going to have different names, right? It's gonna
That's the thing. The biggest ones eventually fall, and then other winners take their place.
right?
But it's not happening right now.
So the question that I get all the time is, can the market hold up if the largest technology stocks fall? And it sounds like you would say the answer to the question is, okay, but something else will rise.
So over the last year, Apple's basically flat. The market's up 23%.
the market
people were
cap
worried
coming
about
out of
that.
people were worried about that.
Right.
Yeah.
And it's happening a little bit with the biggest stock, and the market's doing fine.
Well, all the market cap coming out of Apple went right into Nvidia. So
I
But
was
is
just
that the
gonna-
like
I was just
Nvidia
gonna
wasn't
say
in the
that.
top 10 as
Yeah.
recently as like 2021.
Yeah.
So that's the new one coming up.
Precisely. There's always going to be larger stocks. I agree with you there.
Right.
And if it's not the stocks that we have today, new stocks will rise to take their place.
We just don't know what they are.
We don't know what they are.
Let's talk tax season. So in the Bank of America earnings call, they said, as we look forward to Q2, we expect some modest impact of lower deposits in wealth management as clients make their seasonal income tax payments.
This is another harebrained theory that I have. People pull money out of the market in
Right.
April,
Right.
March and April to pay their taxes.
Mhm.
The effect is amplified after a great year for stocks.
Right.
So 2022, the market was horrendous in March and April.
Right.
Think about how much money people had in cap gains from 21, and they waited for the year to roll over before they sold, and
Right.
they didn't pull the money out.
Right.
So we don't actually know. I think there is some seasonality after a great year for stocks.
John, put the chart up of the average path of the S&P. I found this one. I think this is from Goldman, and it shows this is the average S&P
day.
since
So like I'm not an
1985.
idiot if I believe in this, right?
It's
People
funny
get
though.
mad though when I say this.
Yeah.
Why do people know this is coming? Why does this happen?
I agree. It's great. It shouldn't
Why?
exist.
It shouldn't exist.
It should be arbed out.
Yes.
I was just going to say the exact same thing. If
If it was real,
if
it
the
would.
four of us could figure this out, someone else has already figured it out.
I agree, and yet,
Right.
but it persists.
But it persists. Yeah.
So listen, the Santa Claus effect persists.
100%.
Right.
Right.
Like, you can't deny it. We see it.
Yep.
We see it plain as day.
Right.
So that's a thing that shouldn't exist.
January effect shouldn't exist.
So I think in the end, we're still human.
Now this is like a reason. It's like not that crazy.
If you want to get rid of this, the IRS says, okay, we're going to cut America up into quadrants. If you're quadrant 1, your taxes are owed on April 15th.
Right.
If you're quadrant 2,
They should
it's
stagger it
October
like spring
15th.
break.
Right.
So Warren Pies did some great work on this. He said, John, throw this up. In today's chart of the week, we measure annual, and this is Warren Pies from 314 Research. We measure annual cumulative individual income and employment taxes not withheld. We guess that most of our clients are all too aware that this is tax season. He says from April 10th to May 10th, individual tax payments to the Treasury may exceed, this is a big number, $300 billion. This would surpass the $278 billion drained during the 2022's tax season. Last time that happened, the market fell more than 10%. So the chart on the screen is the cumulative U.S. Treasury deposits, individual income, and employment taxes not withheld. And this is people paying their taxes. And these are real numbers. It's a lot. It's a lot of money.
So again, the last time this happened was on the heels of 21.
Right.
So the numbers are getting bigger. The gains in the stock market are getting bigger in a year like this.
Right.
I don't know.
So we talk geopolitics as like the reason for the stock market falling. What if people are selling because they need the money to pay
Well,
their
that's
taxes?
exactly right. This is not a giant leap. Like, okay, I need to sell some of my portfolio that's up 28% over the last year to pay some of my
Right.
taxes.
Crypto is up 100% in a year.
Right.
Why is Bitcoin down? Well, because people they have a ton of gains they need to cover.
And what would happen if both these things happen at the same time? If we had the brand new geopolitical event,
Yeah.
yields on the 10-year blew up and are heading towards 5%. which is
Armageddon.
Nvidia misses.
Nvidia
Or if
misses.
that happens, stocks will be
You've
going
got-
down like free beer.
Crude is flirting with $90, and people have to pay their taxes. So I think you can bunch all these things together and say, I think everyone's got a hand.
Let's
in
do
this.
this cash stuff. This is interesting to me.
Okay.
Money market
It is in the
funds.
doc. I didn't delete it.
Yeah, look at you.
Okay, there it is. On average, 68% of our deposit balances have been with us for more than 10 years. That's what Bank of America said.
That's wild.
It's kind of wild. People do not move money out of their banks.
You just described to us why.
Yeah.
You've been with your bank for 20 years.
Yeah.
You have a direct deposit. Don't want to change all my bill pay, and it's a pain in the neck for
Ben-
1%.
Ben just went to Italy. There are wealthy families in Europe that have had the same bank for 500 years. You know that?
No, that's
Yeah.
incredible.
And not nobility, like regular people.
Just that this is the
This
one
is
we use.
just the bank that my great grandfather was at, and
But
they
Italy has like 3 banks, though, right?
they have banks though that are hundreds of years old,
Right.
And
so
many vampires. They
and
live a
the,
long
and the
time.
Netherlands also.
Right.
Amsterdam has banks that are older than
Centuries.
America.
So Bank of America's finance chief said, we're all, this is a tweet from Sonali Basak, we are all struck by the sheer amount of cash on the sidelines at this point.
Let's put this up.
And it keeps going higher. So there's $2.4 trillion in retail money market funds and another $3.7 trillion, that's 6.1 total in institutional money market funds. And the line of demarcation there is institutional, that means over $1 million in deposits. I was pretty right about this coming into 2024.
So 6.1 trillion in money market right now.
So I was relatively confident that the money was going to stay in money market funds because it's slow to come out of a checking account and it's slow to come out of money market funds. Once you move it, you're staying. And even if the market's up 20% this year, the money's still going to be there.
Right.
But
So
guys, real quick though, on this chart, in 07, the amount of money in money market funds was like 1.25 trillion. And now it's 6.1.
No. You're looking at the
I'm
blue
adding
line
the two. I'm looking at the navy and the
on
light
there.
blue.
Okay.
So less than 1.5 trillion to 6.1 trillion
Right.
since 07.
But
So-
it begs the question on our last topic, why does $300 billion have to come out of the stock market if there's
Good
6.1
point.
trillion in money markets, right?
Well, because people aren't selling their money market funds.
It's
'cause
too
they're yielding-
juicy.
it's
The
too
yields
juicy.
are too juicy.
You wouldn't walk away from
Well,
that.
the Fed not cutting means money's going to stay here longer because their rates aren't going to fall.
Exactly.
Oh, here. Relative to pre-pandemic, which is Q4 2019, average deposits in money market, right?
No.
Oh, bank
No,
deposits?
next chart, please, John.
Oh, okay.
So I pulled this out from Bank of America's report. Look at the top right. So we're looking at consumer banking. Look at Q4 2019 and look where we are today. So it's up, what is the number?
35%.
35% on average since 2019. It is amazing. Remember people were saying like all the excess savings are being burned off?
Right.
It doesn't look like it.
Not only are they not being burned off, they're generating more cash.
right.
And
Yeah,
these
exactly.
aren't like interest-bearing accounts, right?
Some of them are.
I mean, yeah, 40 basis points if you're lucky.
But it's not much.
No.
It's not a money market.
These are just this is checking accounts,
Right.
savings accounts.
I actually heard from some people, we talked about this, and they emailed and said, listen, the pandemic, COVID really scared me. I'm holding more cash now in my checking. I don't care. It's like a backstop.
Right.
And I think
I think also the money supply is exploded.
Right.
So I think
that hasn't normalized.
I think that the money market funds, the money there is going to stay there for the foreseeable future. And here's what I don't think gets it out. I don't think a roaring stock market gets it out. I don't even think lower interest rates get it out. I think like significantly lower rates. And I'm talking like 3%. Maybe then people start to look for other options for their cash. Because it's comfy, it's fine. You're
Right.
earning money on it. It's not going to chase. This is cash. People aren't chasing with their cash.
So this cash on the sidelines doesn't really make any sense to you? It's one of the things I despise.
Cash on the sidelines.
Cash. There's a lot of cash on the
a
sidelines.
lot of people hate that. Why do you despise it?
Because there's always cash on the sidelines. It doesn't mean it's going to be attracted into the market. And there are people that will say, well, how can you have a 21 multiple on the market and think cash on the sidelines is going to move for that? And the argument to that would be 15 years ago, a 15 or 16 or 17 multiple would be full valuation. Now,
Not anymore.
close to 40% of the S&P 500 has gross margins north of 65%. That wasn't true 15 years ago.
Thank
so
you.
the multiple has to go higher.
There we
right?
go, Art.
So I think that's the point.
So what about? Here's why I hate cash on the sidelines
Mm-hmm.
as a reason to be bullish. if you bring that cash from the sidelines to the market and you use it to buy stocks, somebody has to be selling you those stocks.
Right.
So, so what just happened?
Right.
Okay.
Right. Yeah.
Somebody has to sell you the equivalent amount of stock that you bought.
There's never more buyers than sellers.
Never.
Never.
However, if and this is theoretical, it won't happen, but if there was a wave of $100 billion that wanted to get into the market, then there would be more willing buyers and willing sellers, and the prices would go up.
That's fair.
But
Absolutely fair.
Will we see some of this money come out in the next bear market and say, all right, now it's more attractive. Now I'm going in with some of my cash.
LOL, Ben.
What?
Throw
If, well, I don't know. They cut rates back to 0%, then maybe not for long.
If that happens, then I would say our work here is done.
What?
If in the next bear market you get $100 billion.
Wait, did Ben just ask, will we have a bear market in the next bear market?
No. He said in the next bear market will money come out of money market funds and
All
stocks.
right. Okay.
That is wishful thinking.
Maybe I do like cash on the sideline.
He like. What do we do with bonds here? Can we invest in bonds here? We buy bonds.
Yes.
It's almost 5% across. 2 years, 5%,
Mm-hmm.
5 years and 10 years getting close. It seems pretty darn attractive.
What's
Do you guys
the-
have any 60-40 portfolios for the last 10 years?
Yeah.
Yeah, of course.
How'd that work out?
Pretty great.
Pretty great.
Pretty good. Yeah.
Yeah. For everyone involved.
For everyone involved.
Yeah.
Even
Some
with
years
one
you
really
wish you were
bad
100
Well,
zero.
it sounds like a leading question.
No, it's not a leading question at all. Is that a good idea? It's like, is that balanced? Like in general, if a client comes in and I've got $5 million and I'm 50 years old,
Yeah.
we're going to set you up in a 60-40.
Well, today
is that
it's
a
a
good
better
track
deal
record?
than it was 2 years ago.
Correct.
Yeah.
I don't know if the conversation goes quite like that, but where are you getting at?
I'm getting at, I think, to say, what do you think about bonds? I think it's always a prudent balance in your portfolio because typically, not 2 years ago, but typically, when one asset class is doing better, the other one might not be, and it gives you some ballast. Now, we went through a year where both sides of that did terribly, but that was the first time we've seen that in 25 years.
I
So
feel
to
like
the extent that, if you're not going to have any allocation to bonds, then, you're not really saving for the future. You're actually gambling.
I think that the upside on interest rates,
Mhm.
downside in bond prices is like I don't know where the floor or ceiling is on prices and rates, but it feels like it's like is a 10-year going to go to 6%? Probably not.
Oh man. Uh oh.
I don't disagree with that. Think about it like this. So you've done a lot of great work on what happens when it goes to 5%.
Yeah.
Because then you have to make a hard decision. And I agree with that.
You agree with what I said?
that's
It's kind of like a trigger, right?
It's the pivot, right? It's like,
Yeah.
okay. But we went to 5% in October
Yeah.
and we did have a sell-off.
Yes.
And as an asset allocator, you have to look at that and say, what am I doing here? It's 5%. Then it went to 3 3/4 and the market rallied. To me, it's not so much the levels. So we spent all of the first quarter between 4 and 4.3% yield on the 10-year. That was it. And then in 2 weeks, we exploded to 4.7.
Okay.
It's the move, I think, that freaks people out.
The speed.
The pace, the velocity.
Yeah, I agree with that too.
It's not 4.7 versus 4.3. In reality, it's that. It's when that calms down, if we stay between 4.5 to 4.7, never touch 5, I think things kind of fun.
Well, so Ben's done a lot of stuff on this over the years. Didn't you do something where I think you established the fact that the average 10-year yield over 50 years is 5%?
It sounds like between 4 and 5%. Yeah, we're pretty close to average on
Right.
a lot of rates.
So we're high relative to 10 years ago, but we're average relative
But
to
to your point,
all time.
the speed of the move and the recency bias makes these rates look so much more attractive because for 15 years we stared at 2% yields. Or
This is
whatever.
probably not like a right analogy or comparison. Analogy is the wrong way. Right comparison. But if I wanted to buy bonds, maybe for a trade here, right? And I was more short-term oriented and not asset allocation type mindset, I'd rather buy an equity if I think that rates are going to come back, like a home builder.
Mhm.
I was talking about this with Josh the other day, like Home Depot, for example. Like Home Depot's getting killed over the last couple of weeks. If there is some relief in rates, like
if you want to bet that rates are going to fall, don't buy the bond, buy the stock that's rate
I'd
sensitive.
rather buy a rate sensitive stock.
Right.
What do you think about
It's like
that?
a REIT,
Yeah.
Sure,
a home
exactly.
builder
Yeah.
or Home Depot at that
Exactly.
point. Yeah, absolutely. Because
Why don't you put on your big boy pants and buy the TLT?
I'm saying I'd rather buy Home Depot.
ZROZ.
And by the way, I'm stalking it. I'm eyeballing it.
Which one? TLT?
Long bonds, yeah. I am.
You don't have the guts. I don't either.
So the TLT is still, even with income from the highs, it's still down 44%.
Total
Yeah.
return?
Yeah.
Wow.
It's a widow maker.
Wow.
It's incredible.
right.
Hey,
The only larger widowmaker is natural gas.
well, yes. Joe Weisenthal's questions. What do you think about these things? You're talking about central bank digital currency.
So
You think a lot about this stuff?
I think about it as little as I possibly can, except for the fact that I know you have 4,000 households, and we probably have a similar number. We've got 453 financial advisors, and
Yeah.
someone's going to ask a question because they clicked on an article that tried to scare them into something, and they seem to have the same theme.
What's scary about a central bank digital currency surveillance
The
of
government's
how we
gonna know,
spend?
the government's going to know everything I do.
As if they don't now? Is that-
That's kind of the point, isn't it?
Yeah.
It's like, do you vote? Do you have a driver's license?
Do you have an iPhone?
Right.
Like, I'm pretty sure everyone knows everything.
But it became such a theme in the sort of scare tactic world that Jay Powell had to address it.
He had to address, no, we are
But
not
we-
working on surveillable money.
That's what we're doing. We're talking to banks. We're not talking about you. We don't
I
care
might
about
be
you.
watching the wrong news because I never hear paranoia about this.
Well, we get it from, so it goes like this. You're a broker in Tulsa, Oklahoma.
Watching
Yeah.
InfoWars.
Somebody,
Yeah,
one of your clients
Mainlining Alex Jones.
who's got $4 million, reads this article,
Yeah.
asks you, and you're like, oh, I'll go ask Art. And then I have to sort of hold your hand for a little bit and say, okay, that's not happening. And then the next day it's going to be something else.
Imagine the broker like comes into your office with this shit. And you're like, do you understand? I worked at Morgan Stanley Dean Witter. What the are you asking me about? All right, but all right, so you have to have an answer for this because people are freaked out about money in general.
Money in general, and there's always concerns. But, and I think you guys do great work on this. There's the myths or the scare tactics versus what really important. I thought Joe did a good list of things we should be talking about to a certain extent because they're in the current zeitgeist. But like, I just thought I'd be curious what you hear for the most bizarre questions.
All right, I think the Federal Reserve is going to lose its apolitical status within our lifetime. I just don't think that any institution where the appointees are coming directly from the White House will be able to withstand the pressure of both. It's not just the Trump thing. I just think eventually we're no longer going to think about this as an independent body. We're going to think about this as an extension of the White House the same way we do the Treasury. You think that's a controversial take? Powell might be the last truly independent.
Apolitical. When you think about
Biden kept him.
We've gone through phases of this, though, in the past, right? Arthur Burns, in the 70s, Johnson going in and, saying you just peed on my carpet. How can you do this? So all sorts of things have happened over the history of that organization. The hope is that there's 19 governors and presidents now, that it can be distributed enough that.
But it's a chairman's board in the end. The other governors, they might dissent.
Right.
But there's no brawls,
right?
That I'm aware of, at least.
I don't think there's. I think there's a lot of consensus building. Here's what I would offer up about the Federal Reserve. And you may not be incorrect about this. I think that that there's a potential for that. What I would love to do is have the 10-day quiet period they have before their meeting.
Yeah, it should be 365 days.
I would like to spread that out.
Oh my God,
a bit.
you and I,
because
I've been saying this. It's enough,
right? And unless you have a program in front of you and say, oh, Kashkari's hawkish. So if he said something hawkish, he didn't really say anything. It's the dog bites man. But the market doesn't do that. It's like the algos just haven't figured that out yet.
Yeah.
And it's just ridiculous.
It's 12 of them.
Right.
You have non-voting members going in front of a podium.
Right.
And weighing in and stocks move. It's like, wait, how are you writing these algorithms? With crayon?
Yeah. To the extent that forward guidance was probably important to us during the financial crisis.
Yeah.
I think they really want to say, hey, take it easy. We've got your back here. Everything's fine. But since then, when we sort of normalized the economy there's no reason for forward guidance. And I think Jay Powell feels the same way.
Do you remember Fed decisions where there was no press conference like it was an NBA championship game?
Yeah, 100%.
Do you remember those days? Probably 07, 06, 07.
But then they used to have a press conference after every other one. And then they made a press conference after every one. So when Paul Volcker changed the Fed funds rate, the only way you found out was the next day Chase and Manny Hanny raised their prime rate.
You said, oh, the Fed must have raised rates.
Yeah. Oh, yeah. Look, that's up by 150 basis points.
Well, do you think we'll eventually become numb to it, though? They talk so much now about everything.
Yeah.
And hasn't it been kind of, doesn't it seem like the Fed doesn't matter as much as we all thought from this whole ordeal? They're still very important.
Part of this might be me because I'm very much caught up in the financial media ecosystem and most people aren't. So maybe it's not as irritating to most people as it is to me.
Right.
I just cannot believe how much the Fed monopolizes the media's attention.
Right.
And maybe a little bit the market's attention. but maybe I think it's a bigger effect than it
Is,
really
like
is.
is the Fed like gaslighting investors into thinking
Yes.
they're more important than they are?
Yes, no, they'll put 3 different speakers out in the course of a week saying 3 different things.
But
It's insane. It's a
and
cacophony.
To your point, they're taking up too much oxygen. At the end of the day, to our original point, that doesn't matter because
Right.
they have no idea what they're doing. They can't tell you 2 meetings from now what they're going to be doing.
Well, they tell you they don't know what they say. All right, the Fed says we're going to be data dependent.
Right.
Okay, our first question comes from Bloomberg.
Right.
All right, you say you're going to be data dependent, but what are you going to do in 6 months?
Right.
Well, in 6 months we'll have more data, and then we will be data dependent, and we'll do what we do.
They literally set the rates, and they can't predict what they're going to do with rates in 6 months
That's right.
from now.
100%.
That's right.
And I would argue that the Fed funds futures can't predict what they're going to do either outside of the next meeting.
Look at the magnitude of the moves
Right.
in the futures market. It just tells you how erratic.
Right.
All right.
Wait,
so
So go ahead, finish your thought.
I wanted to ask, where does the CBDC enter into the picture with this stuff? Like, or central?
I'm sorry, we have no time for this. Who cares?
Okay.
So let me just say what does matter. What matters are earnings, and we just heard from Netflix. I'm a shareholder. They added, this is from Lucas Shaw, they added more than 9 million customers
That's a beat.
last quarter, another massive beat. And now has 270 million subscribers and more than 500 million total users. It generated a record profit of $2.3 billion. And the stock in the after hours is down a little bit, which is an interesting reaction. You know what? It's fine. Netflix is up 28% this year. It's up 90% over the last year. So if I had my choice and I don't get to choose what happens with the stock market, I would say like not having a 10% gap up to a beat when you're already up 90% of the last year is probably a healthy thing for the market. Like if we could digest and go sideways and digest, like that's a good thing.
100%. And I would argue that coming into this week, we had that sort of pop and drop every single day.
Yeah.
I think that's more bullish than if we just came out of this week and it said everything's fine, nothing else is going to happen in the Middle East, there's no more geopolitical tensions, and the market just decided to rip. I think that's the worst case scenario. But to your point, Netflix clearly won this game. Remember 3 years ago, everybody told you what streaming was going to look like?
Yeah.
And Netflix said, oh, really?
Yeah.
And you can't share passwords anymore.
Yeah.
It was like, okay.
Now
That was that simple a move?
they're finding ways to make money that they didn't have a couple
And
years
they were
ago.
left for dead.
What's
Yeah.
that?
They were down 75% or
Yeah,
something.
Killed it. The stock was in the spring of 22. That
Right.
stock was $100
Crushed.
something dollars.
Now the stock's falling. It's down 6%. I wonder what they said. But either way, this is it's fine. Stocks can't go up forever and ever and ever. Like they need a period to cool off.
Right.
Stock
And
is selling off on the news that Ripley is in black and white and not color.
Wait, how much is
Can't even
Netflix
afford
up
color.
since the last time they reported?
A ton. They report
They
so
reported
much.
the first week of February.
So the last time they reported, the stock was at 500. It had a ridiculous gap. So the stock's up a gazillion percent. It's okay.
yeah,
Did you do that
I
in
agree with
points?
that.
What's that?
Who do that in points? I don't
Josh
know.
is a points guy.
So
In points terms, it's quite a.
So when you pull up Netflix,
quite a substantial move.
Speaking of Netflix being the winner, they compare it here on this line to Paramount.
Right.
Paramount Global stock is down 8 years in a row,
yeah,
including this year.
Wow.
Right.
it's one of the worst.
It's like they're the
concoctions
opposite of
ever.
Netflix.
Right.
8 years in a row.
8 years in a row. How's it even possible?
You know what's so funny? The FTC and Justice Department are working so hard to prevent mergers.
Right.
They should allow more of them.
Right.
It's destroying these companies.
Yes.
Warner Brothers and Paramount are two highly merged entities.
Right.
They're like 5 companies smashed into one.
Right.
These stocks look like they're going to zero.
Right.
They should be encouraging mergers. If
like-
you're worried about market power concentration, the only one that didn't do a merger was Netflix.
They can also say to bring inflation down. I don't have to pay for so many streamers anymore.
There we go. Warner Bros. too. The stock is just
That merger would be like tying 2 stones together to see if they'll float, right?
yeah.
Hey, I want to finish with Permabears. So you're not a perma bull, but
No.
over time the market's gone up, and you've been bullish for the most part. And I think you do a really nice job at weaving in the possibility of there being risks.
Right.
And that's your job. That's my job. This is what we do.
I think I'm a rational optimist. I think that, and I don't say that in an offhanded way. I think that in general, over time, we get better at fixing problems and being creative.
So I think so too. I think the system gets 2008 is the rare occurrence. It's not the everyday. Okay. The question I wanted to ask you is: do we have anything that we can learn from? Let's say we're not going to listen to what they say the market is going to do, but do we have anything that we can learn from people that are persistently negative all the time? Is there any value in anything that they have to say? And if so, what would those things be from your perspective?
From my perspective, and I listen to everybody's argument.
So do I.
I think the best way to react to that is it reinforces what it is that they're missing, right? So
Okay.
I think some of the biggest value investors are saying this is crazy and value stocks are going to do better, but they haven't for the last 10 years, but this time they're going to, and here is why. And then you can say to yourself, well, maybe there's a reason for that. So small caps, here's a great example.
Yeah.
Small caps, which I would love to see do better.
Every year they're due.
Yeah, and they have been forever, right? And they started, actually, they sniffed a bid in the first quarter.
They were looking good.
You know why?
Took that away in 2 days.
Yields were coming down, and we had sustainable economic growth. They need both of those things, right? They're rate sensitive, but you also need good GDP growth. And then you still have good GDP growth, and then rates go up 30 basis points in 2 weeks, and you're like, all right, see you guys later. And they're trading at 13 times.
Yeah.
And not even the Russell, too. Look at it, the S&P 600.
So the valuation guys will always pitch small caps.
Right.
They never work.
Yeah. And it's hard. I mean, how many
It's
people have
Lucy in
done
the
it?
football, though.
Right.
It's always, this is the moment
This is the
small
moment,
caps
yeah.
will shine.
Right.
Oh, shit. Maybe it's not.
Yeah. But if you look at the yield on a 10-year, and if it doesn't touch 5, and then it works its way back down to 3 3/4 over the next 18 months,
Right.
and GDP is north of 2% over that period of time.
So you look at the people that are consistently wrong with things like that, and then what do you say to yourself?
I say to myself, how did they get it wrong?
Yeah.
What was it that they were pointing at and saying, well, this time I mean it. And, and everybody got it wrong in 23. Everybody. There was nobody that wasn't calling for a recession. It was just like, okay, this is, every time that leading economic indicators have been negative, it's been a precursor. Well, here's the problem with that. And I was like, I get it. I get why you say that, because it's almost a perfect, not a perfect, but almost a perfect recession indicator. It's all about manufacturing. Manufacturing went through a recession. So you got it right, but it was sector specific, right? We went through, manufacturing was in contraction for 18 months.
Yeah.
So you were right. And most of the LEI is manufacturing.
Yeah.
What you got wrong was consumption patterns shifted from goods to services. We over-index services once we can get out and about. That's coming down, manufacturing's coming back up, and that was a false indicator.
Well, also NVIDIA saved everything.
Right.
And NVIDIA.
Yeah. And NVIDIA.
Exactly. Hey, did you have fun on the show today?
Oh, this was spectacular. And I didn't spit the water out of my mouth, which was
No,
afraid
you
I was
did
going to do.
You did great.
And Michael kept trying to get me to do that.
So this has been the first half. We're going to take a quick intermission. We always end the show, as you know, with favorites. And I'd love for you to tell the audience something that you're into these days, you're reading, you're watching, you're following, you think they should hear more about.
I got to tell you this, and this is probably going to be a little out of left field, but Metallica did a cover of Elton John's Funeral for a Friend 2 weeks ago. And
Okay.
I never saw it until I was like looking at something on NPR and it popped up.
Okay.
Michael's a big Metallica guy.
I do
It
like
is
that.
So am I.
the most amazing cover of that song you'll ever see. And all these guys are old. And Elton John's receiving an award, and you could tell how moved he was.
Yeah.
I watched it on repeat 3 times. Had my son come look at it. He was like, "Oh, you like that song?" I was like, "I like these guys," and I was like, "There's the guy who invented it." So it was just one of those things where you're just like, sometimes the song just moves you, and it was both the song and the video. And I'm just like, "Oh, you just have to take a look at that."
Dude, people don't understand. Metallica is one of the greatest cover bands of all time.
Right.
They did a record, I think it was called Garage Days.
Yeah,
So they did 14 covers of their favorite songs. They did Tuesday's Gone by Leonard Skinner.
Yeah.
Turn the Page, Bob Seger was a
a
huge
great
radio
one.
hit in
Yeah.
98.
yeah.
They've done incredible cover versions of a lot of songs, and I think they're underrated from that standpoint. I want to hit you with one more then in the same vein. Zach Brown Band
Yeah.
put out a record recently. They do a big cover song on all their live shows.
Yeah.
So they collected them all and made an album out of it.
Oh, is that right?
And they did Baba O'Reilly. And they
Right.
did like a lot of fan favorites. Anyway, one of the better covers they do, they're in Boston. They bring Steven Tyler on stage and they do Sweet Emotion. Anyway, it's an amazing live record.
Yeah.
It takes place like 2016, 2017,
Yeah.
2018.
They were at Fenway Park when they did that.
Yeah. All right, we're gonna check out Funeral for a Friend by Metallica. Great favorite. Ben, what have you brought us today?
I got a book.
What are those?
I know.
Get out of here.
Nerd.
I'm looking at the classics. I watched the Steve Martin doc on Apple, which is fantastic.
Okay.
It's about his whole stand-up career.
Yeah.
And then going from stand-up into the first half is about stand-up, then the second half is about going into movies. And his book, Born Standing Up, is one of my all-time favorite books.
So good.
It's just really good. His outlook on life and how he sees everything. I love Steve Martin.
No, it's a great scene in that book. He's sitting at the bar, and the guys who would eventually form the Eagles are Linda Ronstadt's backup band.
Right.
So he meets these guys, and they're like, "We're going to break away from Linda and launch our own band." And Steve Martin says, "What are you going to call it?" And he goes, "Eagles." So Steve Martin's like, "The Eagles?" He goes, "No, man, just Eagles." Don Henley, just Eagles. And Steve Martin thought that was so important that he had a whole section of his book about it. I thought that book was incredible. So I second that. Michael,
That's
favorites.
hilarious. Eagles. That wouldn't have worked.
Just Eagles. Yeah, that wouldn't have worked. Okay.
Sorry, one other funny thing he says is he was literally the top stand-up in the game in like the late 70s, early 80s. And he said, this is like the loss aversion thing for investors. He saw like one empty seat at a show and he goes, "That's it, I'm done. Time to get out."
That was the moment?
I can't handle it. There's one empty seat. Like I do not want to get to the place where there's hundreds of empty seats. So I'm out.
I've never seen a stand-up. Have you?
He literally hasn't done stand-up since 1980
say,
whenever he walked away.
It's clips with like him with the fake arrow through his head.
He's just goofy, but people love it.
It's very goofy.
Oh, speaking of stand-ups, Neil Brennan has a new special. He was Dave Chappelle's writing partner on Netflix. Excellent.
I didn't watch it yet. Was it good?
Yeah, he's so good.
I like that guy.
There's a lot of comedians that you watch, you're like, "Oh, that's funny." And there's a few comedians that like make you laugh.
Right.
And he makes me laugh. So I would recommend that. That's on Netflix. All right. Civil War was A24's first ever film to be -- 1 at the domestic box office. And
It's number 1 right now?
It was Friday,
Wow.
Saturday, and Sunday. And the highest grossing opening weekend ever for an A24 movie. This really was it was a war movie. I don't want to give anything away. I know there's been like leaks and stuff about what happened, but it was it really was gripping. What are you laughing at? Say what you got to say.
Duncan said you're recycling takes from Animal Spirits because you already talked about this movie.
Well, I did, but I didn't give the box office stuff.
I love this.
I didn't give the box office stuff.
Also,
him
this
have
is
it.
way too highly rated of a movie for you. It's got 7.6 on IMDb. It's way too good. You can't.
Yeah, it's too high quality of a film.
Bill Arts told me that he saw it. He said it was gripping, and I said, "Hey, that's the exact adjective that I used to
a good word.
describe it."
Yeah.
Right?
Michael normally likes horror movies, but they have to be 1 star.
Right.
No,
He likes sequels to prequels of horror movies.
No, I'm like in like the 5.7 to 6.3 range. That's like my sweet spot.
Right.
All right. Listen, I'm gonna give you a TV show that's gonna blow your mind. You have to commit to me that you'll watch 1 episode. And if you watch 1 episode, you will not be able to stop watching it. It's Amazon Prime. It just came out. It's called Fallout, based on a video game. Don't laugh though,
John was telling me about this yesterday.
because The Last of Us, the best new HBO show in years, also based on a video game. Anyway, forget the video game. It's irrelevant. It's this world where in the late 50s, early 60s, what do you think, 1962? What would you...
50s, yeah.
Okay, it's like just at the turnover.
Yeah.
But that Cuban Missile Crisis-y era, right? Okay. So I'm not going to give anything away other than to tell you, imagine if the missile crisis actually turned into full-blown nuclear war.
Say no more.
Walton Goggins is one of the leads.
Oh, you love that
guy. I love that guy. I watch anything that he's in. They just do such an unbelievable job painting this world that takes place 200 years after 1960 when the world comes to an end.
Right.
All the people who survive end up in bunkers underground. It's like the 1950s never ended, right? But 200 years have gone by. So they invent new technology, but it's based on what they had in the 50s. All the music is Dean Martin, Frank Sinatra, Johnny Cash, because those are the only records that they managed to salvage. And then it goes on from there. But it's one of the most gripping opening sequences of a show. The first 6 minutes where they show what happened, you cannot look away. And then it just gets even wilder from there. I'm telling you guys, I think this is going to be a huge hit. Maybe Amazon Prime's first true bona fide gigantic TV show. So highly recommend. Hope everybody gets a chance to watch it.
That's incredible.
So, all right, that's it for us this week. We want to thank our 2 special guests, Ben Carlson. Thank you so much. Where are you performing? Any gigs you want to plug?
I'll be at LaGuardia A80 tonight.
Yeah.
Waiting for my flight.
Listen, you gave a speech at a soccer stadium in Italy, so you're a big deal now. You're kind of a big deal, right?
I know how to wave.
Yeah. Ben had 2 sets of translators with him on stage in Italy.
Incredible.
All right, Art Hogan, thank you. Art, where do we find out more of your thoughts? Do you have do you have a blog or do you have an email distribution list? What do people do if they want to learn more?
Yeah, so I've got
LinkedIn.
Yeah,
do a little LinkedIn.
I'm on LinkedIn often. I'm on Twitter all the time.
Okay,
So
Twitter.
I've got a Twitter handle in there. And
What's your Twitter handle?
It's Arthur Hogan with 3 I's.
Are you Arthur Hogan the third?
Yeah, I am. And my son's Arthur Hogan the 4th, and my wife, the second he was born, was like, yes, we can name him after you.
Yeah.
But Arthur's kind of a weird name, so we're going to call him by his middle name.
What's the middle name?
Rush.
All right, attaboy.
Nice.
Yeah.
Love that.
All right, Art, you're a long time coming. We've been huge fans of yours forever. I've been waiting for the show. I'm so glad we finally made it happen. Thank you so much.
Thank you.
Thank you for all that you do. We appreciate it. Hey, everybody. Thanks for listening. Make sure to leave us a rating and review. They go a long way. We appreciate you, and we'll see you soon. All right, take us out.